Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use creditor tools, specifically the credit risk rating classification system. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Let's first talk about the regulatory guidance for commercial creditors. Okay, these are the credit risk ratings that are assigned to commercial loans for them to be able to manage their credit risk. Commercial loans are assigned a risk rating for credit risk, or their expectations of being repaid as agreed, or the risk of default. Creditor management is expected to run a tight risk rating system, which means their assigned risk ratings must be both timely and accurate at all times, from loan origination all the way until it's paid in full. Having such a system helps ensure or promote creditor safety and soundness. When the system is functioning properly, it will help facilitate informed decision-making through measured credit risk ratings. Other purposes and functions of the system include credit approval, credit underwriting, guidance for price setting, relationship management, credit administration or the credit administrator, and the creditor's allowance for credit losses or the ACL, including the portfolio management information system, which is called MIS. When we talk about credit risk rating accuracy and timeliness, the regulators insist this is a must. Repayment risk is 100% dynamic, though, and it changes as and when risk changes. Hence, the risk ratings are subject to change any time. Management is charged with ensuring that risk ratings change when they're supposed to change and to the accurate rating. Each risk rating change must be well supported and fully documented. You can begin to see how important your prompt remittance is of your financial reporting covenants and how it is to the creditor, how important it is. If it can't measure your repayment risk, how can the creditor assign the right risk rating, right? And timely too. The creditor will likely need to follow up with you to determine the root cause behind your underperformance so it can ensure the right modifications are in place. You can see how this is a two-way street, where the stakeholders need to work closely together. The lender's risk ratings will be well documented and supported. Risk rating conclusions must reflect any credit risk weaknesses. If the creditor is doing its job, it will dig deep into the root causes. Keep in mind that as you communicate your debt repayment plan, yes, it is okay to ask the creditor what your risk rating is currently. Knowing the rating will help you see any building pressures. Obviously, the worse it gets in terms of a risk rating, the more pressure there's going to be on the creditor and thus on you to either get the loan back to a normal pass rating or even off the books at a zero balance. Let's take a little look at those regulatory credit risk ratings. I want you to become very, very familiar with them. So regulated financial institutions will have a risk rating system, usually numerical, that may include a pass or acceptable rating, and that perhaps there are several levels of pass. A loan properly underwritten may get a pass rating, say 1 through 6. A loan secured by a certificate of deposit or cash would be risk rated a 1. Different levels of a higher pass risk rate would be rated, say, 2 through 6. Furthermore, a loan that has some uncertainties may be designated as a watch credit. Watch is not a risk rating. It's only a designation that's attached to the risk rating. A watch designated loan means it is still, for example, a pass-rated loan, and when the uncertainties are cleared up, the watch designation will be removed. Now for the fun part. The regulatory definitions of risk rating classifications. These are going to be taken from the Federal Reserve Bank, the FDIC, the OCC. These are all regulatory agencies. A loan is criticized. It's called a criticized loan when it is rated special mention. So criticized equals special mention. And then it becomes a classified loan when it becomes substandard, doubtful, or loss. So criticized for special mention and classified for sub, doubtful, and loss. Creditors also frequently refer to all these ratings as being criticized loans as well. So keep that in mind. Let's dive into what these ratings actually mean. A special mention loan. It's credit exposure that, while currently protected by the sound worth and paying capacity of the borrower, it exhibits distinct weakening trends and or elevated levels of exposure to external conditions. In other words, if not checked or corrected, these identified potential weaknesses may result in deteriorated prospects of repayment. These exposures require close management attention to avoid their becoming undue and unwarranted credit exposures. Okay, for example, potential weaknesses in a commercial real estate loan may include construction delays, changes in concept or project plan, slower than projected leasing, rental concessions, deteriorating market conditions, impending expiration of a major lease, or other adverse events that do not currently jeopardize repayment, right? Such loans should receive an elevated level of monitoring. So as these things, potential weaknesses, are explored, the rating goes from a pass rating down to a special mention, which is a criticized rating. Now we're going to talk about the classified ratings. The first one is substandard or sub. Credit exposure that is inadequately protected by the current sound worth and paying capacity of the borrower or the collateral pledged, if any. Exposures so classified must have a well-defined weakness or weaknesses that jeopardize the orderly repayment of the debt. They are characterized by the distinct possibility that the creditor will sustain some loss if the deficiencies are not corrected. Let's go back to the CRE loan, okay? Well-defined weaknesses in a commercial real estate or CRE loan may include slower than projected leasing or sales activity that may result in protracted repayment or default, lower than projected lease rates or sales prices that jeopardize repayment, changes in concept or plan due to unfavorable market conditions, delinquent property taxes, construction or tax liens, inability to obtain necessary zoning or permits necessary to develop the project as planned, diversion of needed cash from an otherwise viable property to satisfy the liquidity needs of a troubled borrower or guarantor. How about material imbalances in the construction budget, significant construction delays, the expiration of a major lease or default by a major tenant without a replacement lease or remedy to default in the near term, poorly structured or overly liberal repayment terms, material collateral damage or other significant casualty losses, bankruptcy or replacement of the general contractor, the major subcontractor, or suppliers, fraud or the misapplication of loan proceeds. So you can see those are all very, very well-defined weaknesses. If you don't get them fixed, it could jeopardize the repayment of the loan. So that is going to be a classified loan, and it's going to be called substandard or sub. How about the next level down? Doubtful. This is where creditor exposures classified as doubtful have all the weaknesses inherent in one classified as substandard, with the added characteristic that the weaknesses may make collection or orderly repayment in full based on currently existing facts, conditions, and values highly questionable and improbable. In other words, there's going to probably be some loss in there, right? It says the possibility of loss is extremely high, but because of certain important and reasonably specific factors that may work to the advantage and strengthening of the exposure, its classification as an estimated loss is deferred and only classified as doubtful until its more exact status may be determined. So maybe they're just waiting for an appraisal, right? But let's look at an example specifically. Use of a doubtful classification for a limited time to permit the pending events to be resolved. Like I said, maybe get an appraisal so you can see what you really have. Circumstances that might warrant a doubtful classification for CRE loans could include collateral values that are uncertain due to a lack of comparables in an inactive market, pending changes such as zoning classification, or there might be environmental issues, or the pending resolution of a legal issue that could affect the realization of value in a sale. Now, what about the last classified rating called loss? This is where credit exposures classified as loss are considered uncollectible and of such little value that their continuance as credible assets are not warranted. This classification does not mean that the asset has absolutely no recovery or salvage value, but rather it is not practical or desirable to defer writing off this basically worthless asset, even though partial recovery may be affected in the future. Losses should be taken in the period in which they surface as uncollectible. Let's look at an example there of this. As a general classification principle for a troubled CRE or commercial real estate loan that is dependent on the operation or sale of the collateral for repayment, any portion of the loan balance, then, that exceeds the amount that is adequately secured by the market value of the real estate collateral, less the cost to sell, should be classified as a loss if that portion of the loan principal amount is deemed uncollectible. That makes total sense. This principle applies when repayment of the debt is provided solely by the sale of the underlying real estate collateral, and when there are no other reliable sources of repayment available. So that's it. That's all you've got. Collateral is only worth X. The rest of the loan that's basically unsecured needs to be classified as a loss and written off. Doesn't mean you don't owe it still, but that's how it's accounted for. This short ad is sponsored by the Debt Crisis Problem podcast. Attention, listeners. Please join us at tunabudget.com to tune into the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Speaking of next, let's talk about credit risk management and the roles and responsibilities, okay? And I want you to be aware of these at the creditors level, okay? This is the established lines of defense to ensure accuracy and timeliness, okay? Internally, creditors may have various roles and functions for maintaining accurate and timely credit risk ratings. The first line of defense will be your primary relationship officer, who is primarily responsible to continuously ensure the accuracy of the credit risk rating. This responsibility cannot be abdicated under any circumstance. This officer has the authority to recommend and approve credit risk changes by carefully evaluating any perceived changes in risk characteristics. This includes upgrading or downgrading a loan, okay, to the right credit risk rating, upgrade or downgrade. And of course, the next line of defense would be a rating validation from those individuals who have the higher or highest authority to approve the loan. Such persons can change the risk rating if they want to, if desired. Now, the third line of defense would come from individuals who belong to an independent group, okay? Generally reports, for example, like to the board of directors or some committee thereof, okay? They don't report. They're not in the loan production loop anymore. They're out. This group is outside. They call them loan review or credit review. Its risk rating decision is final and overrides all other assigned risk ratings, so that independent call can be made if there's a disagreement or what have you. But they're always sampling and reviewing loans that are made, and they have the ability to change any risk rates at any time on any loan. Next, let's talk about deal structure, loan approval, and leadership and the teams that do this. Okay, credit administration staff are responsible to support the line lending staff in the review, structuring, and approval of credit requests. They serve as a second line of defense, as I just mentioned. And credit administration will ensure appropriate and consistent application of the lender's credit standards and all their credit policies. Credit administration officials are in constant contact with the primary relationship officers in reviewing their loan portfolios, identifying early potential problem loans, and they review the credit risk ratings. Now, once a loan is assigned, let's go back to the watch designation for uncertainties, or even downgraded from a pass rating to a special mention or substandard. The credit administrator or the credit administration will become more actively involved with the loan officer. The plan will be to assess the current situation, establish a written action plan. This includes all the little steps and the completion dates for each step to get the credit risk rating back to a pass rating or to exit the relationship altogether. These teams will also work together to analyze and determine the underlying root causes of credit deterioration based on the financial information reporting that you provide them. This may also include other sources besides financial reporting, like checking account activity, trade reports, market information, their personal observations, and discussion interviews with you. So now, once your loan is downgraded to special mention, okay, first one was the watch designation because of some uncertainty. Now we're talking about an actual criticized loan risk rating. It's called special mention. And especially substandard, it's a classified rating, the credit administration staff will continue to work with the pro on writing up regular, and that can be monthly or even quarterly, repayment action plans. Okay? The purpose of these monitoring reports is to show how and why the action that will be taken to bring the loan back to a pass rating or to a zero balance as soon as possible. In those cases where a further downgrade or a risk of non-accrual, that's where they shut the interest rate off, if you would. They don't take, it's an internal thing only, where they shut off the accrual of the interest, okay? Or if there's any loss possible, or it's possible that a transfer of responsibility for the entire customer relationship from the pro could be given to another specialized department called the Special Assets Department, and that which may be very appropriate and perhaps even likely. So let's talk about what happens if your loan goes from the regular lending relationship you've had with your relationship manager or primary relationship officer, and if your loan is downgraded to, say, substandard, and it goes to a different officer in what's called the Special Assets Department, or SAD, S-A-D, what if it ends up with a member of that team? So while the pro and credit administration teams will regularly service loans that are risk-rated special mention, and some of them even substandard, like I said, but on occasions, loans so rated, they may require a lot of extra time and specialized attention. And that's why it goes out of the regular pool, if you will, and into the Special Assets Department. Okay? These are specialists that have the tools to get things done. And this team will scale up or down as problem loan volume fluctuates over the years. But again, they are equipped, depending on the size of the department, or otherwise have access to all the legal professionals, appraisers, all the tools are at their disposal for getting your loan back to a pass or even down to a zero balance. So in other words, when they feel a borrowing relationship is going to need additional workout tools, all those legal maneuvers, collateral liquidation, or whatever it takes to force repayment, Special Assets Department, or SAD, can do the job. When the volume of problem loans overwhelms the creditor in a severe economic downturn, borrowers will be expected to propose their own repayment solutions. There will be a big paradigm shift, which will be in everyone's best interest. Thank you for joining us. Today we covered the creditor tool, Credit Risk Ratings, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nicara.org. If you found today's episode helpful, Please subscribe for notifications of future podcasts. Your feedback helps other small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.